I failed at trading for years. I learned every single concept imaginable. I did, penny stocks, I did futures, I did options, forex, day trading, scalping, swing trading. I learned everything about technical analysis, support and resistance, indicators, VWAP, volume profile, level 2, ICT, SMT. I did all of it, and there's only one concept in all of trading that made me profitable. I don't even use 95% of what I studied. So in this video, I'm going to teach you what that concept is and how you can use it to become profitable. Okay, so the concept is liquidity. Now, before you click off, I guarantee you, if you're not a consistently profitable trader, it's because you're not using liquidity properly, right? And there's two different ways of using liquidity, because I thought I understood it at first, but I didn't, right? The first is to use liquidity to get your direction, so you target highs and lows. And the second, which most people get wrong, is a liquidity sweep, right? Liquidity gives you the direction, the liquidity sweep gives you the entry. You need both of them to become profitable. You need both of them to become profitable. Most people don't, they have one but not the other. So in this video, I'm going to teach you what it is. So the first thing you want to do whenever you're on the charts, and I'm just going to teach you on the 15-minute chart because we're not going to do daily buys and all that. There's loads of videos on the channel about it. We're just going to look at the 15-minute chart. And what you want to do is you just want to look at key highs and key lows. You want to ask yourself, where are stop loss orders going to be? Because these markets only move for liquidity. They only move for where the money is, right? Smart money will only move where they can actually get into a position. So you want to ask yourself, where are obvious stop loss orders, right? We're on GBP USD. And, this works on all markets. So someone's asking me this. This works on every single financial market. If there's candlesticks like this, liquidity is what moves the market, right? If we've got candlesticks like this, it's because liquidity moves the market. So what we're going to do is we're just going to look for key highs and key lows. And it's pretty obvious, or at least I hope it's obvious. At this low here, see these lows, these relatively equal lows, there's lots of support, right? There are retail traders and there are retail funds. This is so important, right? There are retail funds that trade support and resistance, right? Not all funds are profitable, right? I've said this a lot, right? You might have heard the stat where it's like 90% of hedge funds underperform the S&P 500. This is why, because they don't know how to trade, but they make most of their money from commission. So it's their investors who lose money. But anyway, that's not what we're talking about. What they think, right? What these large funds think, who have billions of dollars, they think that price is going to come down to this level and then bounce off, right? They think it's going to bounce off there, and they think it's really safe to put their stop loss orders here. Now, this is what we call liquidity. Let me just make this obvious. This is what we call liquidity. It's stop loss orders. That's what we're doing. We're targeting stop loss orders. That's all we're doing in trading, is we're just going to target key highs and key lows where stop loss orders are going to be, because we know that's where large funds are going to have their stop loss orders, and smart money are going to take the other side of their position. If smart money wants to buy, they need sellers, right? And they don't need me to sell. They don't need me and you to sell because we don't have enough money, right? Smart money wants billions. They need someone. If smart money wants to buy like billions of dollars worth of, let's say, GBP USD, they need someone who's going to sell billions of dollars worth of GBP USD. They need these large hedge funds that are unprofitable. So smart money and these large funds, they come together. That's the only reason these markets move. It's not because of VWAP, it's not because of volume profile, it's not because of any of that. That's the only reason these markets move. Just for liquidity, just for stop loss orders. So the first thing you want to do, and this is what I always do when I get on the charts, is I just ask myself, where would the obvious stop loss orders be? Right, where would support and resistance, these sort of traders, where would they put their stop loss orders? And this works on all time frames, but obviously the higher the time frame, the better. The 15-minute is so good for day trading because this will tell you more often than not where price is actually going to go on that day, right? So let's just remove this arrow, right? So at this level, there's lots of liquidity, lots of stop loss orders. What does that mean for us as traders? What does that really mean? It means we want to short. We want to target this low, right? We want to do something like this. We want to see price come down to this level, bounce off, give the illusion that there's, that this is really good support, right? And then we want to see price make some bearish move down and then enter on some sort of retracement like that, right? Sell the rally and then target this, right? The key thing is we target stop loss orders. Like, someone got confused about this. A few people were asking me, they were saying, do we wait for liquidity to be taken and then do we enter like somewhere here? No, we don't do that. What we do is we target liquidity, right? Liquidity gives us the direction of the market, right? Because to trade, you need to have a direction. The first thing you need when you get on the charts is a direction. Once you've got the direction, then you look for your entry pattern. And that's how you use liquidity. That's the first stage of liquidity, which is just giving you the direction. For the second part of trading, the second part of liquidity is you need to have a liquidity sweep, right? It's just so important because so many traders, lots of people understand liquidity. There's so many YouTube videos online, right? Lots of people understand liquidity. They can get the direction right, but they just can't get into a position. They just can't, whenever they enter, price will do something like this. And this used to happen to me all the time, right? How many times does this happen to you? Let's say you're shorting, right? You've shorted here. Your stop loss is there. Price has come all the way up, takes out your stop loss, and then goes straight to your take profit, right? How many times does that happen? Your stop loss is here. Price comes up, takes out your stop loss, and goes straight to your target, right? Your liquidity target. And then you think, oh, the market hates me, the market's not grudging me, I can't do this. The whole reason why that's happening is for a liquidity sweep. Now, a liquidity sweep is essentially, it's a fake move in the opposite direction of the real move. Now, what does that really mean, right? Liquidity on the higher time frame, and in this case, the 15-minute chart, for day trading, right? Liquidity is going to give us a direction in the market. This is where the major stop loss orders are, right? If you just look at the charts, where are the major stop loss orders going to be? They're going to be these equal lows, right? That right here, this liquidity gives us a direction in the market, right? We've got the direction, but for smart money to get into their position, they're going to need, they're going to need more stop loss orders, right? Because, it's easy for us. I can just press sell on GBP USD, right? I can just sell GBP USD and I can get into a position. But if you've got billions of dollars, you can't do that, right? You can only do it at major highs and major lows. And every single high, right? Every single high here, that price comes and takes out, is a liquidity sweep. Now, the reason it is because the real direction of the market is to go short, right? The real direction of the market is people are going to go sell. Smart money traders are going to look to sell because they want to target this, where there's billions of dollars worth of stop loss orders. Now, in order for them to get into their position, they're going to start taking out other people who have gone short, right? These markets, there can only be so many people who are going short. Like, for every winner, there's a loser, right? You got to think, when you enter a trade, you hit take profits, someone lost. Right? That's just the way it is, right? There's a winner and a loser. So what smart money does is, let's say you were correct here. I mean, how many times has this happened, right? So this is London. This is golden time, 2 a.m. And this is for forex, by the way. There's 2 a.m. and this works on all markets, but I'm just going to teach you on forex. For this example here, 2 a.m. right here, 2 a.m. Eastern. Let me just get this up, right? 2 a.m. Eastern New York time. Now, I live in the UK, but I still use New York time because all the financial markets move based off New York time. So 2 a.m. Eastern, right here, all the way down to around 10 a.m. Eastern. That right there is the golden time for forex, right? Any entry there will do. So that's when the most volatility, the most volume is at that key time of day. So at this point here, there are people trying to go short, right? Early London, they understand liquidity. They know there's liquidity here, and they're looking to short. So what's actually happened here is some traders have gone short. They put their stop loss orders here, right? They've gone short. Let's say they try to, sell the retracement. They put their stop loss orders here. They think it's nice and safe. Price comes up, takes out their stop loss orders, instantly aggressively drops the other direction. That right there is a liquidity sweep. It's a fake move. The only reason this candlestick pumped up here was just to take out stop loss orders here. Anyone who was short here got taken out, and then price quickly, aggressively drops in the other direction. That right there is a liquidity sweep, right? And then you always want to wait for that. So let me just mark this out, right? Let's make this very clear. So right here, let's make it like this, is our liquidity sweep, right? Our liquidity sweep. Let's make this a bit smaller so it's more clearer. So this is our liquidity sweep, and you always want to wait for this. Always want to wait for this, because this is what finally made me profitable. I would get the direction right all the time, but my stop loss would always get hit. And I used to trade London, right? So my stop loss would always get hit. I would be short, let's say, at a fair value gap or an order block or something, maybe on the 5-minute or 1-minute chart. Price would come up, take out my stop loss, and then quickly and aggressively move to my target, right? It's very annoying, very annoying. And the reason it did that is because I didn't wait for a liquidity sweep. Didn't wait for a liquidity sweep. The liquidity sweep is just a stop run in the opposite direction of the real buyers, right? So the real direction is done at major highs and major lows, right? This is the real direction of the market. This is where the real money for GBP USD is, right? You're going to ask yourself, where are retail traders and retail funds, where are they going to put their stop loss order? Are they going to put it at these equal lows, or are they going to put it at a random high, right? They're not going to put it at the random high, but there will be some people will have their liquidity there. Some people will have their stop loss orders there. And all that does is it allows smart money to sell as these stop loss orders get taken, right? So all you want to see is the opposite direction of your buys. You just want to see a stop run in the opposite direction. That's it. And then any entry after that is high probability. So what we're really saying, let me just, let's just do it here, right? Let's just suppose this is a liquidity sweep. Let's just say this is a high, this is a liquidity sweep, right? Price quickly and aggressively drops in the direction. It shows us that it's bearish, right? Quickly moves in that direction. What we want to do, enter on the retracement. Any sort of retracement then is really high probability. And then we ride price down to our liquidity target, right? And that's exactly what happens here. So let's make this clear, right? What happens here is price moves. This is the fake liquidity sweep, fake stop run here. Price only comes up for a liquidity sweep, take out this high, then it drops massively and aggressively, and then we want to enter on any sort of retracement, ride price down. That right there is probably the easiest trading model that actually works. Now, it might be complicated at first, but with experience, you'll get this. And most profitable trading models are based on a liquidity, a liquidity for the direction, and then a liquidity sweep before they get hit, right? Most profitable traders, they always wait for a stop run, and then they enter the trade. Because if you don't wait for a stop run, your stop's going to get hit, and then price is going to go into your target. So right now, we've got the direction, we've got a liquidity sweep. Any entry pattern will do. This is so important, right? The entry pattern is literally the least important thing, right? If you've got liquidity here, obvious liquidity, right here, we've got the direction, we know where price actually wants to go. You've got a liquidity sweep, a fake stop run, and then price quickly, aggressively moves in your direction, confirming to us that we are bearish, right? If price, and I say this all the time, if price did something like this, right? If it took out this stop and it went like that for ages, slowly moves down, that's not a liquidity sweep. But because price literally came up like that, quickly and aggressively moves in the opposite direction, that right there is telling us we're on the right side of the market, right? We're on the right side of the market. Any entry pattern will do at this point. So I'll give you, let's just take this order block here. So, because someone was asking me this in the comment section, they were asking me, how do I identify order blocks and what's a high probability order block? A high probability order block, and this is for your notes, it's when we're bearish, it's the last up close candle before the down move. Now, what makes an order block high probability is it will have a fair value gap. It's the gap between these two candles and between these three candles, right? So this candle here, that's a fair value gap, right? That's a fair value gap. This makes the order block high probability, and it's so important, a liquidity sweep. Right? If you've got a liquidity sweep for an order block and you've got a fair value gap attached to it, that makes the order block super high probability, right? Any entry, and this is something for you to know, this is so important. Any entry after a liquidity sweep is high probability, right? Any entry after a liquidity sweep is super high probability. So your entry could be, let's say, at this order block here, right, which you hit during New York session, right? So you could be a New York trader like that on the 15-minute chart, nice and easy, right? No messing around on the 5-minute chart. So we're just on the 15-minute chart here, and then you could target, let's say, 2-to-1 or 3-to-1, right? 3-to-1 like this, which you probably have to. What do you have to do? You have to hold on into early London, right? New York, so you hold for about just under a day. If you really want a 3-to-1 and you really want to target liquidity, that's what you could do. Or you could just target an easy 2-to-1, right? A 2 or 3 risk to reward ratio is all you need for day trading. All you need for day trading, right? And let me just tell you something. I do this exact same thing on the 4-hour chart, right? I used to do it on the 15-minute when I day trade. I do the exact same thing on the 4-hour chart. Now, I'm not going to get onto the 4-hour chart, but just imagine, price is fractal. What that really means is it doesn't matter what time frame you're on, these principles apply. Now, the lower the time frame, the less reliable it becomes, on like the 1-minute chart. Because, and I'll just show you this really quickly, right? Because I'm getting a bit off topic here. On the 1-minute chart, what you might have is sometimes, let's say this is a liquidity sweep here, especially for indices, you'll get like a double liquidity sweep, right? You usually get this at like, let's say 10 a.m. Eastern time. 2 liquidity sweeps, fair value gap, price comes in and then drops, right? So you might see that on NASDAQ and ES if you trade futures, but we're not going to talk about that here. And for me personally, this is my entry pattern. I just use a Fibonacci retracement, and this is called the optimal trade entry. Does not matter at all, but the entry pattern is the least important thing. What I would do normally, let's just move this a bit down like that, right? What I would do normally, I would enter like this, right? Like this. Yeah. And because I'm day trading, let me just aim for a 3-to-1. I'd aim for a 3-to-1 like this, right? Like that. And now because I'm day trading, if I was day trading, you have to you got to account for spread. Now spread is just the difference between the bid and ask, right? I usually just do like a pip, right? Just do a pip, right? To actually get into a position, because the difference between the buy and sell price is, that's your spread. But we're not going to talk about that, right? There's videos about spread. It's not interesting at all. If you're a day trader, you always want to factor in spread just to actually get into the position. But if you're on the 4-hour chart, spread isn't relevant because your stop loss is going to be like 100 pips, so it doesn't really matter. But yeah, that's just something for your notes. So any entry pattern here will do. There's a fair value gap entry here. If you really wanted to just get into a position, right? If you didn't really care, you just wanted an easy, let's say 2 risk to reward ratio, like that, right? You could get this and then hold on until the next day. Or you just aim for a 1-to-1, right? I know people who literally, their whole trading model is something like this, right? They aim for a 1-to-1, like that. But then they risk 2%. They risk 2% of their account instead of 1%. They risk 2% of their account. Per trade, they've got a really high win rate. I say really high. They got about, like, let's say a 70% win rate. 1 risk to reward ratio. Their psychology is good because they rarely lose. Personally for me, I aim for a 3 risk to reward ratio, probably because I'm a swing trader now and I don't get as many sells. But, if you were a day trader and you wanted to aim for a 1-to-1, you wanted a high win rate, this is something you could easily do, right? Something you could easily do. But it doesn't matter, right? It doesn't matter. The only thing that matters, let's just remove this, right? The only thing that matters is, let's just zoom out a bit, is that you have the real direction. Let's just make this clearer. You've got the real direction, which liquidity gives you, the real direction of the market, and the exact same principle would apply on the 4-hour or daily chart. But the real direction of the market, you wait for your liquidity sweep, you wait for the fake move in the opposite direction. You know it's a fake move because you know where the real direction is, right? We know the real direction is down here. So we're just waiting for the fake move. You wait for the fake move, which is the liquidity sweep. and then you look to enter on any stock retracement. It could be a fair value gap, it could be this order block, it could be an optimal trade entry. It does not matter. It does not matter. As long as you've got this framework, you'll be a profitable trader. And this is literally what made me profitable, right? And it makes my students profitable. But yeah, that's all there is to this video. I hope it makes sense. If not, do let me know in the comments like what you want me to cover and stuff. And I've also got like a little bit of a surprise, right, I guess, for you guys. So in the comments, on the pinned comment, there should be a free trading model for you to use, right? So if you're struggling with trading, you need a trading model. It's a free full like PDF guide that you can use to start trading and making money. And as long as you apply this concept of liquidity, you'll become a profitable trader. But other than that, make sure you like, subscribe, and leave a comment what you want me to cover next. And I'll see you guys next video. Peace.